The reality is, if you look at the data historically going back to the 70s, supply is the number one thing that supports a softening of rent, and we're seeing that now. As supply is cresting, you're seeing rents market-wide down 4.5%. If you look at the temperament of the investment community of developers, it's very difficult to put a shovel in the ground today.
Yeah.
It's very difficult to transact today and find debt, find equity. When I think about a stable business climate, you want to avoid the black swans.
Sure.
And there's a lot of potential black swans occurring right now. Are underway. So, how do we diffuse those? How do we move into an environment where it's more calm? You just know that a presidential campaign year, things get a little heated.
It's season 3, baby. We are back, long awaited. JC, lovely to see you again, sir.
Good to see you.
Lovely to see you. For all those data junkies that are out there, I have the king of the data junkies sitting right next to me. So we're going to talk everything multifamily, of course, macro, jobs, capital markets. I'm probably not going to be talking very much this episode, to be quite honest.
That's a first.
Thank you. I appreciate that. John, let's start with on the national side first regarding macro. What are you seeing currently right now?
Well, I think the trend from Q4 in terms of GDP is trended down. I believe we were at 3.4% in Q4 of 23. Q1 came out at 1.6%. That was revised recently to 1.3%. And just so the audience knows, I have some data points here. I want to make sure that we're accurate with those descriptions. Actually, today is the day that CPI came out.
Yeah.
So CPI was 3.3% in May, so slightly under estimates. Mm-hmm. So the trend is good in terms of that, as the Fed targets 2%. And of course, the Fed committee came out just after that and just said we're holding steady at
no decrease.
5.25, 5.5 is the target. So I think the dream for Wall Street, the markets, interest rates, multifamily of getting at least 3 rate cuts this year is probably unlikely. So ideally, we get something in September.
Yeah.
And CPI continues to trend towards target.
I wanted to say, I just checked. I know we're going to talk single family home market, but I just looked at the 30-year fix, 7.84 today.
Amazing.
Yeah. 7.84.
Yeah.
We'll talk more on that. I didn't want to stop you. Sorry about that.
So, I think those are the big takeaways. I think, from a consumer perspective, which we know participates in about 70% of our GDP, they move the needle, we move the needle. Mm-hmm. They continue to boost the economy, but there's trends in terms of them saving less. Credit card debt is getting to, I'll say, max levels. Piggy banks are getting smaller, and they just continue to rack up that continuous debt. So how long does that last? I'm not sure. Wage inflation still exists. So, receive it, spend it kind of format. I'm not sure how long that can last.
And let's talk more on the capital market side too, nationally. What are we seeing there?
So nationally, from a multifamily perspective, of course, there was a big uptick. Multifamily's been kind of the darling at the dance over the other sectors.
Yeah.
Right beside industrial investment. But last quarter, Q1 was the lowest on record since 2020. So that means we peaked in Q1 of 2020, and that's come back. I believe it was down to 19.8 billion. But still the number one sector in terms of investment, it just compressed. So we know a lot of reasons are behind that. You've saw, nationally rent growth has dissipated and
Yep.
really went negative last quarter. It's very tough to get a loan today, and it's difficult for equity to sign the dot because they don't see any trend lines that make sense. And expenses are up 6.5% year over year, with insurance being up 36%. So
ouch.
A lot of dings in terms of NOI and projected growth, causing that market to be a bit stuck.
Anything else nationally from your perspective?
Yeah, I think you have to look at supply. So in Q1 of 2024, we broke the record for number of units delivered at 135,000 and change.
Yeah.
That broke the previous largest quarter, which was Q4 of 2023. So two cresting
Back to
moments
back,
nationally. And vacancies have grown for 9 consecutive months, up to almost 6%. Multifamily expenses up 6.5%, which is causing issues on the NOI front. And then, really from I'll say one positive takeaway is the absorption numbers nationally. So also in Q1 of 2024, 103,000 units were absorbed, which is the largest first quarter on record since 2000.
Still amazing.
And well above the average of 38,000 and change for absorption. So, 3x what it typically is. But again, we're still not absorbing as many units that are being delivered. So that's a concern from a vacancy perspective.
Right. Let's go right into state of Arizona, our home. What are you seeing here?
Well, it comes down to what I would say, repeating Ivy Zellman, the single family market for sale is stuck or frozen, whatever analogy you want to use. Affordability today is about 22% in Phoenix Metro when you consider the median income locally. In 2019, it was just over 62%. Wow. So it's drastically changed for the worse from an affordability perspective. And when you think about home ownership in terms of mortgages across the country, over 62% of folks holding those mortgages are 4% or below.
Why would you
trade out, right? So if you factor in the difference between, I think you said earlier, pre-conversation, what's 7.8%?
7.84 is what I saw just recently.
If you just compare the data on, you just say it's a 400,000, which is about the average median across the country, $400,000 home.
Yeah.
You're spending another $800 in terms of just interest rates a month from 4 to 7%, and it's higher than that. So it's probably 900 to 1,000. So very difficult for folks to move into that space, which is obviously helping prop up the multifamily sector because you have a variety of Class A renters that potentially would go buy a home, but they love their location. It's an affordability play. Maybe they don't have the down payment money, so there's a holding or frozen approach.
And let's talk about that as far as Class A renters that would normally, because that's normally our number one reason for moving out. That has recently changed.
Correct.
We talked about that previously, didn't we?
Sure.
Yeah.
Yeah. And so it's transformed into moving out of state and or locally. So meaning it's not the single family momentum that's carrying them out of those locations. And I think the most telltale sign is turnover. So when you look at turnover,
I was just going to ask you that too.
Turnover is the lowest on record year to date, just ahead of 2021, which was our best year operationally. Overall, historically, but having that low turnover is really impacting, I'll say, operations from saving on expenses from a turnover perspective, and really kind of propping up that occupancy because of the lack of movement. Now, how long that lasts, I don't know, because turnover is typically the leading indicator as we move into a contractionary environment. Who knows what happens? But for now, it's incredibly positive to see that number hold true.
Sure. Let's. So we already talked about capital markets. Low transactions this year, construction, and also like as far as delivered units and also current pipeline absorption. Let's dive in there.
Yeah. So Phoenix Metro, we have 40,908 units under construction.
Still amazes
today.
Me. Yeah.
About 50.5% of that is accounted for in the Southwest Northwest Valley.
Right.
And about 50% of that construction is BTR, SFR in combination. I think it's important to know that we had not delivered more than 10,000 units in an individual year since 1986 until 2022.
Yeah,
when we delivered just over 13,000 units. So if you look at the trend, we moved to 13,883 in 2022.
Yeah,
16,787 in 23. We're going to crest over 21,000 units in 2024 and back that up with another 17 to 18,000 in 2025. So if you just look at the bucket of deliveries from 11 through 2020, so last decade, we delivered 59,000 units and change. 21 to 24, we're going to deliver about 60,000 units. So it's a lot of pressure on this market. So the question is, what kind of absorption are we seeing? And year to date, we've averaged about 69% gross absorption, and that's just new units in terms of what's coming to the market.
The
what's
entire
being absorbed.
valley, correct?
Right. So if you just think about that in terms of deliveries, we've had a steady increase since 2023 into 2024, and it just builds up that inventory month after month after month. And you're going to see us peak at about 11,000 vacant units just sitting there in July or August of this year. So that puts a lot of undue pressure on the stabilized market, meaning stabilized assets, and obviously the lease-up assets that are coming online during that time period. So, absorption is key. You're going to have ownership groups that choose to hold rents, maybe not play the concession game, and not take their medicine and not absorb at the pace they need to, which would get you into trouble. I think that today, positively, demand's been very strong, which we'll talk about momentarily when we get into marketing.
Good.
So another positive like turnover helping us maintain some dynamic of absorption and protecting a bit of the stabilized asset community.
Well, let's jump right into ops and marketing.
Okay.
Let's figure that piece out.
Well, I think from an ops perspective, as we know, occupancies and effective rents are down. Concessions are up, as one would expect, especially with the new deliveries. And I think you have to, you can't ignore the impact of expenses. So expenses up about, which I mentioned, 6.5% year over year. So you're having some NOI deterioration because of all of those factors.
Sure.
The good news is it's maybe not as bad as it could be because of the things I mentioned in terms of low turnover, low affordability on the single family side. And I just think, demand is the other piece which shifts to marketing. Our year over year demand to marktaylor.com, which mostly operates as an independent ILS. If you think about it, from a scale perspective, up 40% year over year. That's tremendous. And that's unique IP addresses. So it's new users. And you're seeing California remain as the number one source outside of Arizona. Yeah. But you have some significant increases. So Texas is up almost 300% year over year. Again, could be cost of living, could be other things. Colorado up 28%, Montana 35%, Nevada 33%. To round out the top 10, New Mexico 6, Utah 7, Idaho 8, Wyoming 9, Virginia 10.
That still amazes me, Idaho and Wyoming.
I think a piece of that is pandemic driven. So you had folks that were leaving large municipalities, large cities, large metros saying, I'm looking for affordability, I'm looking for space, not knowing what was going to happen during the pandemic. And what you did see is rents skyrocket in those locations. Right. Cost of living skyrocket. So the affordability play, that gap shrunk.
Supply decreased.
Right? So, hey, do I go back to the large city now that I feel comfortable? Now that pricing's pretty comparable.
Sure.
And I think you're seeing a component of that.
Yeah.
With that shift.
Yeah. Continue down the line of marketing. We're talking about the southwest, northwest submarkets having the largest amount of deliveries, right? What has been driving that demand out in that portion of the valley?
Well, certainly you have to think about infrastructure. You have to think about cost of living, and also the ability of, I'll say early this last cycle of SFR proving themselves in terms of build out and lease up pace and rents. So you had a lot of attractive land pricing. You had low cost construction elements. So it was very affordable to build a BTR SFR back in 15, 16, 17, 18, 19. That's certainly changed today. And you also have to factor in the transformation of just that West Valley portion in terms of infrastructure. So you have the 303 being open from an infrastructure perspective. You have over 45 million square feet of industrial already delivered.
Just going to say the boom industrial.
And we're now number one in the country, now ahead of Dallas in terms of under construction industrial warehouse. So that's a tremendous lift and boon to the West Valley. And certainly you have to factor in TSMC in the north. That has been, I think, something that we can't quite comprehend in terms of investment volume. Now announcing Plant 3 or Fab 3. So just under $60 billion of investment, and the magnetic effect of that from a supplier perspective. All of these suppliers moving to North Phoenix and or just Phoenix Metro to support TSMC. Estimates are 95 to 125.
And we haven't
companies.
even had the announcements yet, right?
Just some.
Right.
Some. And so the key is, we're kind of in that in-between stage. We're in full-blown construction. Phase 2 of Fab 2 has been topped out. Phase 1 will deliver their first chips in 2025. So we're not even manufacturing and delivering that product yet. So we're going to get those permanent jobs for not only TSMC, but also the suppliers as they build out that platform. So I think there's a lot of exciting things ahead from a manufacturing perspective. I believe we were just ranked number one in terms of manufacturing growth opportunities from 25 through 30. And no question there. And you also have to factor in Intel, which we don't even talk about, which was the darling of manufacturing semiconductor,
where I live.
still under construction on their third fab.
Absolutely.
So another big, $20 billion investment. So I think the barbell, the lens of we're focused a lot on onshoring, putting jobs back into Mexico, back into the Southwest. I think all those things are relevant in terms of our success story from a jobs perspective, which we didn't even talk about jobs yet.
Let's talk about jobs. That was a great. Thank you for throwing that out for me.
Segueing for you.
Wow.
So extremely disappointing Q1. So again, we're kind of in an in between stage.
Yeah.
We had our slowest Q1 on record since 2009, and April was a bit of a bump. So we adjust our forecast, monthly. Annually, right now, we think we'll get 2.1% growth, which is about 53,000 jobs. Great for some markets, a bit underwhelming here in terms of considering our average pace last decade was about 63,000 jobs. So when you factor in what does that mean for multifamily, it's really about demand. Jobs are the only thing that create future apartment demand. And if you do the math, that creates about 10,000 units of demand, roughly, which is half of what we're delivering. So we really need to see jobs tick up sooner than later to really help offset some of this immediate supply side pressure.
And do you see investors, developers still bullish on the Phoenix market?
Yes and no. I think if you look at the temperament of the investment community of developers, it's very difficult to put a shovel in the ground today.
Yeah.
It's very difficult to transact today and find debt, find equity. We've only had 18 transactions year to date from 50 units and above. So if you look at that pace, it's going to be probably, if you finish the year, let's just say we double and we get to 36, that's still relatively low. It would be the third worst year on record. Slightly ahead of 2009, but man, that's low. And after just having 49 last year, it's just a tough 2-year stretch for the brokerage community in transactions. So anyone tied to that piece of the equation from a business perspective, they're suffering. So we know rates are a big component of that, specifically when you have trend lines of NOI deteriorating.
Right.
And you're not seeing the rent growth that was explosive, from 18 to 22. So we don't know when that shifts, but I think you gotta see some interest rate deductions to start to get that deal flow back up again.
We talked about a couple factors already as far as the slowdown, not just on the capital market side, but just going past 26 and into 27. What are some other factors besides interest rates, labor cost? What else would you say is just a challenging piece of what we're seeing right now?
I think regulations are a concern. Water's a concern. Not that we necessarily don't have enough water. I think that myth has been buried, despite the pejorative narrative in the media initially. But the reality is, now it's under the microscope. So will developers be positioned negatively around the no water storyline? I think that's a concern because it's certainly something the NIMBYs are, and when I say NIMBYs, not in my backyard folks.
Sure.
Folks that are very much against development, they're going to use that as another weapon in their tool chest. So some concerns around that in terms of construction costs, that narrative, regulations potentially. It's a big election year, so you could have a real shift in terms of the pro-growth business community if the Republicans lose the House and the Senate next year. With a Democratic governor. So just the reality is if the Dems control all three, that gives way to rent control, potential bills, and other things that could deteriorate the opportunities here from a new business perspective, multifamily, et cetera, et cetera.
I was actually just on a call on a webinar with NAA, National Apartment Association, just talking about what's happening across the country. They had a large section of what I was listening to was about state of Illinois, my home state, specifically Chicago. They had some very aggressive bills that were introduced about trying to implement rent control. Luckily, and great job, Chicago and Illinois for doing this. They fought down and beat each and every one of those. But it's going to be a continuous uphill battle moving forward. I mean, we talk about it all the time, of course, with our lobbying efforts here. Yeah,
I mean, the reality is if you look at the data historically going back to the 70s, supply is the number one thing that supports a softening of rent, and we're seeing that now as supply is cresting. You're seeing rents market wide down 4.5%.
Yeah,
and that will continue as supply pressure continues until we absorb these units, and it's going to take some time. It's going to be 26, 27. I used to say take your licks until 26, but I think it's
You're going.
I think it's going into 27.
Do you have a new catchphrase for 27?
I haven't thought of one yet.
All
but,
right, I'll hit you up on the next episode.
It'll come to me.
All right,
I
good.
promise.
You mentioned the presidential election. Now, talking politics never a great idea unless we're actually in the political game right now.
Sure.
I'm going to hit you up though either way. So historically, when it comes to a presidential election, confidence level, not just on the investor side, stock market, everything that is always paused because you just don't know what's going to happen, what's going to change. Do you see that harming one way or another? I know you talked about it a little bit already, but here locally, what could happen here for us?
Well, I think, I mentioned the political landscape of Arizona, and just to add to that, I think today the House is, +1 Republican. I think it's 31-29. I think the Senate is 16-14 or 17-13. So it's a very tight window in terms of, who controls what. So if both flip, that's a concern. When you think about the national, presidential election, if you look back historically in our data set, you'll see, as you mentioned, more of a slowdown, a pause, Q2, Q3, Q4 of those election cycles.
Yeah.
It's pretty predictable. And I think it's kind of a wait and see game. Who's going to get elected? We had the opportunity to participate in the John Malden Strategic Initiative Conference, and we showed this in our macro meeting that we hold once a month. And Bruce Melhan Consulting talked about Biden Trump 2.0, a sequel no one wants to see. And I think that's been very true based on the data that I've read in terms of people wanting something different as a candidate. So you have Kennedy in the mix. No Labels was essentially shut down because of the attacks from the left and the right, not getting them on the ballot, someone not wanting to run in that space. So here we are with Biden Trump. So I think the good news is that this is, I think, the first time in history that you've had two presidential candidates with 4-year terms on record. Yeah. So, there's really, I think I saw a poll the other day where 31% of folks were undecided. What's to be undecided? You have 4 years from 16 to 20 to see what Trump did, and you had 20 through now to see what Biden did. So depending on what you like to see from a policy perspective, you kind of know what they're all about. So I'm shocked that number is that high, but we'll see. I think from a multifamily lens, you certainly want to ensure that taxes remain under control. Yeah. So the tax cuts that were implemented in 2017 are set to expire, I think, in Q3 of next year. So that will be a big debate within the Senate and House. And I'm certain if those are not extended, that's going to be concerning for this business climate, et cetera. So there's a lot of concern around that. Who wins? Who knows? But I think when you look at the business community, the tax rates, the geopolitical issues, and just expand that, like what are the concerns today? You could say we're virtually in World War III. There's a lot of wars happening right now across the globe. There's a lot of tension, a lot of uncertainty, and when I think about a stable business climate, you want to avoid the black swans.
Sure.
And there's a lot of potential black swans occurring right now. Are underway. So how do we diffuse those? How do we move into an environment where it's more calm? But the reality is, if you look back, you just know that a presidential campaign year, things get a little heated across the board.
So based on when this comes out, of course, we have the first debate between Biden and Trump coming up. I think is it next week or the week after?
I'm not even sure.
But either way, I learned that one of the requests was they were able to sit down and not stand at a podium.
Well, I think that sometime in season 3, and maybe Brian and Allie will allow this to happen, we should stand. See if we can get through. I
don't know if I can make it.
30 minutes.
I don't know if I can make it. We'll see what happens. Well, hey, I told you from the beginning, if you were a data junkie, this is where you need to come and turn to. John, really appreciate it. Tradition, let's keep this going. What are you grateful for today before we close out?
Because of my experience yesterday, I won't name names, but I think The relationships within the multifamily sector or industry have been so beneficial to me personally and professionally over the years. I can't, thank those people enough. Influencers in my life, folks that I've connected with, that have supported me along this journey. I think that could be translated into really anyone's sector or anyone's focus in life. So, there's a lot of crossover friendships, work relationships, all of those things. And I just appreciate, all of those people, supporting me supporting them. And I love our industry. As I think Todd mentioned in one of our podcasts, no one really focuses on getting in to multifamily.
Yeah.
But wow, once you're in, there's so much opportunity for growth and connectivity and just an overwhelming group of great people. And I absolutely love it.
Perfect.
What about you?
I'm going to give a little shout out to our master videographer behind the camera right there. I know you can't see him, but Brian, wanted to say thank you, brother. Amazing job telling us what to do, where to sit, what not to say, what to say. Thank you, Brian. And really appreciate it.
You can't see him, but he's looking good. His hair's growing out.
And he's just, look at his smile on his face right now. We'll have to get him, on this side maybe one time.
We should.
Talk about all the skills, what happens here.
We should switch roles, then it would never get produced. The camera angles would be, all
you'll see is the top of your forehead if I was behind there.
Lighting would be off.
Yeah.
We'd save a lot of makeup, though, so we don't have to, diminish this glow up here.
You're the man. Well, thank you again, everyone, for joining us. Once again, John Carlson, Adam Greco, Multifamily Forward, presented by Mark Taylor Residential. We'll see you next time.